We are going to look at the stock of the day, which is Insurance Australia Group IAG. And IAG has renewed its 2.5% whole of account quota share arrangement with Hanover Re, effective from July 1, 2023 for a term of 5 years. The renewal provides consistent financial outcomes and covers 32.5% of gross claims costs, reducing the need to purchase additional catastrophe program coverage. IAG has also purchased aggregate and fourth event reinsurance covers for the financial year ending June 30th, 2024, offering protection of $250 million in excess of $600 million. So, we are going to now focus on IAG. Now, Philip, these insurance stocks have been amazing performers. They are beneficiaries of a higher interest rate environment, but we have had so many catastrophes, which really has been working against them. So securing this reinsurance is surely, a good thing for IAG. How are you seeing it?
Look, it's definitely a positive. We have had a lot of catastrophes in Australia and New Zealand over the last couple of years with bushfires, floods, earthquakes in New Zealand. So catastrophes are at almost record high levels, if not record high levels. That means the cost of reinsurance has gone up materially. So insurance companies like IAG, QBE, Suncorp, who run retail brands in Australia and New Zealand, they themselves take out insurance because they don't have the balance sheet to pay billions of dollars in catastrophe claims. So reinsurers around the world have said, well, Australia and New Zealand's been risky. We are hiking up our reinsurance rates. And what's happened in the last few months in Australia is that the major insurers have now looked at how much reinsurance can they afford to pay for, how much balance sheet risk can they retain themselves. And what we've seen almost to a company is that they just can't afford to pay, or it's not economical to pay, have the same amount of cover at the new rates. So they're taking out less reinsurance coverage and maintaining more risk on balance sheet. So an example, if they were previously retaining the first 250 million of catastrophe claims, they might now retain 300 or 350 million. So they're taking more risk on balance sheet. However, they themselves have material pricing power because their costs are going up, just like every other industry. When the costs go up, ultimately the consumer pays. So at a recent strategy day, IAG gave the market an insight into the price increases they're putting through. In home, we're looking at price increases of around 20%.
Yeah, it's
in
huge,
Australia.
Isn't it?
Motor 14%, commercial 15%, then New Zealand around 20%. So all these extra reinsurance costs will actually hit us as a consumer in the hip pocket. And if you've got that sort of pricing power, if you're an IAG, it is a company worth looking at. Analysts consider this to be fair value because it's had a good run. But for me, a company that demonstrates that sort of pricing power in an industry where interest rate rises actually benefit it, I actually think it's worth looking at. So I'd call it a buy.
Okay, well, our first buy of the day. And Claude, what are you thinking about IAG?
I think in the long term, I would avoid having a long-term holding in insurers just because the dynamic Philip was talking about means that you're basically positioning to suffer if it turns out that there is a lot more extreme weather from climate change and that the actuaries are having more difficulty modeling that correctly, as opposed to taking the bet that, oh, don't worry about climate change, the catastrophes aren't going to be an issue. I think it makes the core value out of an insurer is the actuaries who can do all the numbers and get the pricing right. I think that's a lot harder when you're changing a system rapidly, as is occurring in terms of the atmosphere and the concentrations of CO2. So that's a problem with it long term, and for that reason, I don't like insurance long term. However, I actually agree with Philip. In the short term, at least, he may take a long term view, but I actually say in the short term, it is probably a good buy. I think today of all days, we're seeing the market readjusting to higher interest rates or higher bond rates, however you want to think about it. And I have been happy. Look, I think it's quite clear for the last year or so, we've been in a different regime. Previously, the bet to take for like 10 years or more was lower for longer or lower rates, basically. Position yourself for lower rates. It's like shooting fish in a barrel. A lot of people like myself just got lucky because you get that one thing right and then everything is helping you. And then now it's a different regime, and the bet to be taking more has been actually higher for longer. And just because of the dynamics of the interest that they then get from their investments in the float, insurance companies are actually a reasonable way to play that environment. So I guess at a certain point, the market expectations of rates will get too pessimistic, and actually inflation will be coming down more across the board, and things will be easing. And at some point, I would want to get out of insurance. But for now, I think that it's a reasonable bet with the momentum. Risk reward is in your favour.
Yeah, absolutely. Tailwinds in terms of a rout in the global bond markets at the moment. But I think you make some really interesting points there in terms of the longer term business model, given that we're seeing El Nino hitting at the moment across the Northern Hemisphere. But nevertheless, that is very exciting because we have two buys for stock of the day, IAG.